Oil prices have come down by approximately 40% since June of 2022, and have recently broken below a support level that held the price of oil up between 2021 and 2024. Oil's price bounced off the support 4 times before finally breaking it a couple of months ago. The last few times we've seen a clean break below a key support level like this one has led to oil's price moving down substantially lower. But of course, this type of move down needs to be driven by fundamentals. Oil's price is in great part driven by manufacturing activity in the United States. We can look at that through an indicator called the manufacturing PMI, and this is what it looks like. High readings on the manufacturing PMI correspond to strong growth in manufacturing. Low readings correspond to contractions in activity, and when the indicator is at 50, it means that manufacturing is neither growing nor contracting. Up and down cycles in the US manufacturing are very closely correlated to oil's price trends. Now, you may be wondering why we're just looking at U.S. manufacturing here, because the U.S. is actually still the world's biggest consumer of oil. They make up about 20% of the total global oil consumption. China is not far behind, but for the sake of simplicity, we'll be focusing on the U.S. in this video. Since about late 2021, manufacturing activity in the U.S. has been declining, and that has led to the decline in oil prices we've been seeing since then. If oil's price is set to decline significantly from here, that would need to be accompanied by a further weakening of manufacturing activity in the U.S., which would take us into contraction zone, something that only happens during economic recessions as indicated by these recession bars. All of the moments where we saw manufacturing activity reach these kinds of contractionary levels were during economic downturns. We'll take a look at how likely this scenario is in a second. Many investors today argue that with Donald Trump's presidential win, economic activity in the U.S. is likely to pick up, and that could lead to a substantial move higher in the price of oil. This is exactly what happened following Trump's election in 2016. He implemented tax cuts for corporations that immediately led to a pickup in manufacturing activity. This led the price of oil to begin trending higher. It's yet to be seen whether the same thing is set to happen this time around, but certain signals could be pointing in that direction. For example, this chart right here. This is something called break-even inflation, and it basically measures how financial markets are pricing inflationary forces. And very recently, the market's expectation of inflation has been rising quite rapidly. Many argue this shift is taking place in anticipation of Donald Trump's economic policies. Now, usually these inflation expectations are very much tied to the price of oil. We can see that clearly by overlaying the chart of oil on top. They are a mirror image of each other. But recently, break-even inflation has been moving higher despite the fact that oil prices are still quite low. This could be a sign that markets are anticipating that oil is poised to begin rising as a result of economic stimulation that Trump's policies could provide. This is the bullish case for oil, that oil prices have not yet fully reflected the impact of Donald Trump's policies. However, if we zoom out a little bit further to see what happened to oil prices during Trump's first mandate as president, the results are a little bit more mixed. In the first half of his term in 2016 and 2017, we did see oil's price rise, but in the second half in 2018 and 2019, oil prices turned around and began to go lower, and this was long before the pandemic. So the question of whether or not Trump's presidency will inevitably cause a boom in oil prices today is more complicated than it looks. At the end of the day, oil prices pay more attention to economic trends rather than the president's policies. We can see that clearly if we add a chart of job openings on top of oil. This is another great way of looking at the strength of the United States economy. We see that job openings are very much correlated to the price of oil. As the economy strengthens and sees an increase in the number of job openings, oil tends to move higher, and the opposite is true when job openings are declining. This is what drove oil's behavior during Trump's first mandate. Job openings were rising during the first half of his mandate, indicating a strong economy and allowing oil prices to rise. In late 2018, the job market began to weaken and oil prices also turned around. We've seen a very similar dynamic between 2020 and today. During the first half of Biden's term, a very robust U.S. economic recovery after the pandemic drove the price of oil higher as job openings hit record highs. Since then, we've seen a steady weakening of the job market in the U.S., and that has been accompanied by lower oil prices. That's the bearish argument for the oil trade, that if the economy continues to weaken, oil prices will continue to move lower as well. The worst case scenario for oil would be to see another recession occur. The last recession was, of course, in 2020 as a result of the pandemic. Oil crashed down to $0 a barrel. But predicting when a recession is going to materialize is an impossible task. Many investors have been trying to call for a recession over the last 2 to 3 years with no success. It could be that the job market ends up being quite strong over the coming months. The war that is taking place in the Middle East hasn't yet shown signs of de-escalating. In fact, the possibility of a full-scale war between oil-producing nations is still very much a reality. Oil's price history shows us that wars in the Middle East have been responsible for many of the large and rapid price increases on the asset. The Yom Kippur War in 1973 the Iranian Revolution in 1979, and the invasion of Kuwait in 1990 all led to substantial price increases in the price of oil. An escalation of the ongoing conflict in the Middle East is a big upside for oil in the present day that traders should be taking into account when it comes to oil. Now, although there is no de-escalation of the conflict, we also don't have any clear evidence of any real escalation either. We can see this by looking at an index called the Geopolitical Risk Index. This index shows us how high geopolitical tensions are around the world at any given point in time. We can observe the spike in geopolitical tensions that occurred in early 2022 during the Russian invasion of Ukraine, and also a brief spike in October of 2023 when Hamas launched an attack on Israel. Since then, we haven't really seen any big increases in geopolitical tensions or even an uptrend in geopolitical tensions.